Stocks, bonds, and currencies are things you can actually own. When you purchase them, you hold a real asset. But derivatives work differently. Instead of owning something directly, you're entering into an agreement. It's a financial contract whose value depends on something else. These contracts can generate significant profits, but they also carry serious risk. So let's break down how they work. Options and the strike price. Imagine you're thinking about going to a concert, but you're not completely sure you'll be able to attend. Now picture paying a small fee today just to reserve the ticket. Later, if you decide to go, you can buy at the agreed price. If not, you simply walk away. That idea is very similar to how options work in finance. An option gives you the right, but not the obligation, to buy or sell an asset at a fixed price sometime in the future. That fixed price is known as the strike price, and the term derivative here doesn't refer to mathematics. It simply means that the option's value is derived from another asset, such as a stock, commodity, or index. If the price of that underlying asset changes, the value of the option will usually change as well. There are two main categories of options: calls and puts. Call versus put options. A call option gives you the right to buy an asset at a predetermined price before the contract expires, but you're not required to do it. A put option, on the other hand, allows you to sell an asset at the strike price within the same time limit. Because these contracts allow you to decide whether or not to act, they're called options. The choice is entirely yours. Options are also divided into two main styles, American and European. With American-style options, you can exercise a contract at any moment before the expiration date. That means you have the freedom to buy or sell whenever it suits you during that period. With European-style options, the contract can only be exercised on the exact expiration date, not earlier. Most stock market options follow the American style, which provides more flexibility for traders. There are also other variations, such as binary or Asian options, but American and European contracts are the most widely used. Quick recap. Let's review the key terms. American options can be exercised at any time before they expire. European options can only be used on the expiration date. Call options give you the right to buy, while put options give you the right to sell at the strike price. And every option is linked to an underlying asset, like a stock or commodity. Once you become familiar with this terminology, you'll start hearing traders say things like, I purchased a 3-month call on Microsoft with a $450 strike price. Example, a wheat farmer using a put option. Now imagine you're a wheat farmer, and your harvest will be ready in about 3 months. Your biggest concern is that wheat prices might drop before you sell your crop. If the market price falls significantly, your income could take a serious hit. To protect yourself, you decide to purchase a put option on wheat. This contract allows you to sell your wheat at a predetermined strike price. If the market price falls below that level, you can exercise the option and still sell at the higher strike price, helping you avoid a large loss. But if wheat prices rise instead, you simply ignore the option and sell your crop at the better market price. In many ways, this works like insurance. You pay a small upfront fee called the premium for protection. If you need the protection, it's there. If you don't, you simply let it expire. Futures and the futures price. Futures contracts operate a bit differently. With options, you have a choice about whether to complete the trade. But with futures, there is no choice involved. A futures contract is a binding agreement. It requires you to buy or sell the asset at a specific price once the contract reaches its expiration date. That predetermined price is known as the futures price, rather than the strike price used in options. When the expiration date arrives, the transaction must take place. There's no backing out. Example, futures contract for wheat. Let's return to the wheat farmer example. Instead of buying a put option, imagine the farmer signs a futures contract for wheat. This locks in the selling price for the upcoming harvest. When the contract expires, the wheat must be sold at that agreed futures price, regardless of where the market price stands at that moment. If wheat prices fall, the farmer is protected because the contract guarantees a higher selling price. However, if prices rise significantly, the farmer still has to sell at the locked-in price and misses out on potential extra profits. Futures in the stock market. Futures aren't limited to agricultural products like wheat. They're also widely used in financial markets. One well-known example is the S&P 500 E-mini futures contract, which follows the performance of the S&P 500 index without requiring investors to purchase all the individual stocks within it. Each contract represents 50 times the value of the index. So if the index is at 4,000 points, one contract represents a value of $200,000. That means traders can control a large market position without paying an entire amount front. The original S&P 500 futures contracts were even larger. Each one represented 250 times the index value. At 4,000 points, that would equal $1 million per contract. The E-mini version, being only one-fifth the size, made futures trading accessible to many more investors instead of just large institutions. There's also one more key concept involved in futures trading: mark-to-market accounting, often shortened to MTM. Unlike options, where settlement usually happens when the contract is exercised, futures use a system called mark-to-market accounting, often shortened to MTM. Instead of waiting until the contract expires, profits and losses are calculated and settled every single trading day. If the market moves against your position, the loss is deducted from your account that same day. If the market moves in your favor, the profit is credited immediately. In other words, you don't wait until expiration to see the result. Because of this daily adjustment, traders must keep funds available in what's known as a margin account. This account ensures that any gains or losses caused by daily price changes can be covered. Quantitative finance learning. If you're interested in going deeper into quantitative finance, there are many educational resources available online. These programs often cover everything from the basic concepts to advanced mathematical tools used in professional trading and financial analysis. Some courses also explore the models and techniques used by analysts and quants to understand market behavior. The over-the-counter market, OTC. While many options and futures are traded on formal exchanges, not every derivative works that way. Some contracts are created and traded in what's called the over-the-counter market, usually shortened to OTC. In this environment, two parties negotiate and agree on a contract directly with each other rather than using a centralized exchange. This setup allows the contract to be customized in ways that exchange-traded products usually cannot. However, it also introduces a different kind of risk. Since there is no exchange acting as a middleman, each side relies on the other party to fulfill the agreement. If the counterparty fails to meet its obligation, the other side could face problems. Forward contracts. One example of an OTC derivative is the forward contract. A forward contract works very much like a futures contract. Two parties agree today on a price at which an asset will be bought or sold at a specific date in the future. The key difference is that forwards are privately negotiated rather than traded on exchanges. Swaps. Another common OTC derivative is known as a swap. As the name suggests, a swap involves two parties exchanging certain financial payments with each other. Exactly what is exchanged depends on the specific type of swap agreement. Example, interest rate swap. A common form of swap is the interest rate swap. Imagine that Company A has taken out a loan worth $100 million with a fixed interest rate of 4.5%. Meanwhile, Company B also has a $100 million loan, but its rate is floating, meaning it changes over time. The interest rate on B's loan is based on SOFR plus 10 basis points. Understanding SOFR and basis points. SOFR, or the Secured Overnight Financing Rate, represents the rate at which financial institutions lend money to each other overnight. It's widely used as a benchmark for floating rate loans. A basis point is a unit used in finance to represent very small percentage changes. 1 basis point equals 0.01%. So 10 basis points equals 0.1%. Why the companies swap? Now, consider the situation of these two companies. Company A believes interest rates might decline in the future. Because of that expectation, it would prefer to have a floating rate instead of the fixed 4.5% it currently pays. Company B, on the other hand, prefers stability. It would rather pay a fixed interest rate, so its borrowing costs remain predictable. To solve this, the two companies enter into a swap agreement. Company A agrees to pay Company B SOFR plus 0.1%, while Company B agrees to pay Company A 4.5%. Importantly, the companies are not exchanging the actual $100 million loans. Only the interest payments are being swapped. How payments work. On every scheduled payment date, Company A sends Company B the current SOFR rate plus 10 basis points. At the same time, Company B pays Company A the fixed 4.5% rate. Instead of transferring the full interest amounts both ways, the two sides typically calculate the difference and settle that single net payment. What happens when rates change? Suppose the SLFR rate rises to 4.8%. In that case, Company A would owe 4.9% after adding the 10 basis points. Since Company B only owes 4.5% in return, Company A effectively pays more than it receives. In this scenario, Company B benefits from the swap. But if SLFR falls to 3.7%, Company A would pay 3.8%, which is less than the 4.5% it receives from Company B. Now the advantage shifts to Company A. This illustrates how interest rate swaps allow one party to exchange the certainty of a fixed rate for the potential benefits or risks of a floating rate. Who uses swaps? Large financial institutions, corporations, banks, and hedge funds commonly use swaps to manage their exposure to interest rate changes. Sometimes two parties arrange the swap directly with each other. In many cases, however, banks act as intermediaries, structuring the deal and collecting a fee for their role. After all, financial markets rarely offer anything completely free. For common derivatives, options, futures, forwards, and swaps are for the most widely used derivatives in finance. But financial engineering doesn't stop there. The number of possible derivative structures is virtually unlimited. Exchanges provide standardized options and futures contracts, while the OTC market allows institutions to create customized agreements like forwards and swaps. And if a financial institution needs a contract tailored to very specific conditions, there's almost always a bank or counterparty willing to design that deal.